Hey, Brent Richardson here. I hope you'll join me today as we walk and talk about what's happening with mortgage rates, and more specifically, why rates are likely to hold higher for longer in 2025. So specifically, there was an employment release. It was for May. It came out last week for the month of May. And this number was interesting because it actually showed that unemployment ticked up by 0.01%. It ticked up to 7%, which is a big round number. It has a significance having a 7 there. But at the same time, the reason for that unemployment was only due to population increase. So the population increased faster than new jobs were created. So this had the effect of increasing the unemployment rate. With that said, there was actually 58,000 new full-time jobs created in Canada in the month of May, which took pretty much everybody off by surprise, especially given all the news, all the negativity out there, which, is quite justly out there, given all the trade issues. So big surprise to see all these jobs come out, these full-time private sector jobs. This was offset by some part-time work from Elections Canada. Public sector work for part-time went down significantly, and really there was in May 8,000 net new jobs, all full-time, all private sector, but still it was stronger than most had expected. So continue along the theme of our conversation from last week, given the Bank of Canada's decision for what they're going to do with interest rates. This increase in jobs in May is seen as economic strength. All right, so not as weak in the job market as was expected. Now, this of course could fluctuate. It's not guaranteed to go in a straight line, 58,000 new jobs every month. Pretty sure there will be some fluctuation, but it wasn't the direction that most, including the Bank of Canada, had expected the employment market to go in May. And so, given this, the bond market and bond yields went up. Okay, they had a bit of a spike on Friday, and that's the main thing we're concerned with. There can be debate over how strong or weak the job market is, but at the end of the day, if the bond market goes up, if bond yields go up, the price of bonds drop and the yields go up, this affects fixed mortgage rates. This adds pressure to fixed mortgage rates when bond yields go up, irrespective of why. The bond yields are up, this puts upward pressure on fixed mortgage rates. So that's one thing we need to keep in mind is fixed mortgage rates may be creeping up a bit more. The other thing is the Central Bank of Canada, markets price in. Financial markets, bond markets, esoteric market instruments such as 4-year swaps and other instruments, they price in it and they anticipate what the Central Bank of Canada will do over the coming months and even years. And so the financial markets taken together are anticipating that the central bank doesn't cut their rate until October. And more specifically, 0.25% cut in October, and that being the last cut in 2025. So one more cut in 2025 is what the financial markets are saying. Again, this could change. It's likely to change over the coming months. And again, even the central bank anticipates economic weakness. And so I don't think we're out of the woods. With that said, again, there are some positives out there that could create an environment where there are no more cuts. There are interprovincial trade barriers that are dropping. That's actually a really positive sign for Canada, a really positive development. There are nation building projects such as pipelines that may have a better chance than over the previous 10 years. There are other infrastructure developments on a national scale that are being proposed. And so there's also the trade deal that could come between Canada and the US. So if any of these things develop positively, we could absolutely see the central bank, just hold rates and focus on combating inflation. So we're going to keep monitoring this. We're going to see if it's more negative economically, whereby growth is slowing and employment tanks. That will probably cause rates to be cut. We're also going to keep our eye on inflation. And so right now, the markets are betting that the Bank of Canada will be more focused on inflation, because once inflation's out of control, it's much harder. It takes way more effort to get inflation back under control. Whereas the GDP, if employment, if it drops and keeps dropping and it's looking worse and worse, well, you can always cut rates in the future. And in those cases, inflation will probably be kept in check to some extent. And again, by cutting rates in the future, this would give the economy a bit of a boost. It's not going to solve all our problems, but it would help to mitigate issues that are coming up as a result of trade. I also think, as one final point, that this trade talk between Canada and the US is probably what Canada needed to wake up. So for years, it's been frustrating. We've seen Canada languish and not really focus on its development and overemphasis on housing. But now there's an emphasis on what can we do to better ourselves as a country? What can we do to grow? And so I think it's encouraging that we're seeing trade barriers come down interprovincially, and we're also seeing some more projects being discussed, and it'll be interesting to see if they move forward. But I'm cautiously optimistic that even though rates might not come down as much as we want, we might not see 3% for fixed rates or even 3.5, although we could. But I'm optimistic that Canada will continue to grow, and that will be more focused on better jobs and growing incomes, growing productivity, than having to get ahead with a lower mortgage rate. That's everything for today. Appreciate your watching, and I hope you have a wonderful day. Thank you.